What is going on with multifamily real estate? If you know me, you know I'm really into multifamily because for the last couple of years, that's pretty much all that I've been buying, or all that I've been talking about buying. The truth of that comes in the next video. I'm going to break it down into 3 reasons why multifamily real estate is struggling right now and why you've been hearing about it in the news. Potential investors who are thinking about putting money into a multifamily real estate project, but they're scared because of what they're hearing and want to educate themselves on the risks and benefits. Balance what they're hearing from a potential sponsor, which tends to be overwhelmingly positive, with the overwhelmingly negative that they're hearing on the news. And the truth, as always, is somewhere in between those two extremes. But if you're getting your investing advice from the news, please don't. The news is designed to shock and alarm you, and those are 2 things you never want to feel when you are thinking about your investing portfolio. Shock and alarm is what creates the huge volatility spikes in the stock market. Because it's liquid, people can just buy and sell according to a whim. Real estate is a lot less liquid, meaning that it's not as volatile. And so instead of being able to sell things quickly when the news starts to say that this might be in trouble, instead we just worry about it. So what's been going on in the news? I'll tell you what I've seen in patterns with not only the properties that we own, but also the properties that we're invested in as limited partners. First and foremost, the biggest factor is that interest rates are going up. We all know that, but how does it affect multifamily real estate specifically? The commercial lending is not like residential lending where you get a fixed rate loan for 30 years. Most people don't know that. I didn't know that before I started getting into the space. If a property is in really good condition, it can qualify for a fixed rate loan, but the term is almost never 30 years, with the exception of a couple of government-backed loan types like a HUD loan, which most properties won't qualify for. Multifamily real estate loans are not like residential loans where you get a fixed rate for a 30-year term. You're going to be seeing variable rate bridge loans of 3, 5, 7, maybe 10 years. The loans are usually amortized over 30 years, but because they're balloons that have shorter terms, this forces commercial real estate into a sale and refinance cycle that we're not going to see with residential real estate. What's causing a disturbance in the commercial real estate world, because a lot of loans are coming due over the next several years, and they're not going to be able to refinance at the same low rates that their current loans are at, or they're going to have to sell for lower prices so that the same amount of rent coming in can cover the higher payments. There are trillions of dollars of loans in the multifamily real estate space that are coming due in the next 5 years. And the refinance rates that were underwritten a few years ago, we had no idea if rates would continue to go lower or even negative. So even though conservative underwriting would have said we will refinance at a higher rate than we're in right now, having them go up so fast really was unforeseen. But the higher interest rates are not just a ticking time bomb down the road when properties need to sell or refinance. You have 2 types of properties that you can buy. Some that are in great shape, or some that are in really bad shape and need a lot of work. These are called value add. Value add properties do not qualify for stabilized lending. If there's a lot of deferred maintenance and the property needs a construction loan, or if occupancy is less than 80%, this is considered a distressed property, and those kinds of properties are not going to qualify for fixed rate long terms. Even a stabilized property is not really going to go beyond 7 to 10 years. When you add in the extra risk of distressed value add properties, the loans are going to account for that. Sometimes they're interest only for 1 to 2 years. Sometimes they have a fixed rate for 1 to 2 years. Sometimes they have a variable rate right out of the gate. So if interest rates are climbing during a period of time when a property is under construction and not stabilized, then the payment is going to be going up while the property income is going down. And the reason it goes down is because when a property is not stabilized, meaning it needs a lot of construction, vacancy is going to go up, because when people move out, that apartment needs to be turned over. It needs a lot more work and it takes a lot more time. Even if it's a great property that's leased up as soon as the apartment is ready, the time it takes to move somebody out, do the construction, and move somebody back in extends the vacancy on a property. Multiply that over 100 units and you can see how that starts to add up. So properties that were bought near the height of the market that needed a lot of work, where almost immediately after the purchase the interest rates started to go up on variable rate bridge loans, are the ones who are feeling a lot of pain right now, because the payment went up while the income went down. So why get a bridge loan, many people will ask. And bridge loans have been criticized pretty heavily in the press recently, being seen as almost irresponsible. And in some cases, they have caused a lot of problems. But imagine if bridge loans and construction loans didn't exist to help get distressed properties back up to market standards so that they could be traded on the retail market instead of being traded as distressed properties. Who would lend on them? Who would make it possible for somebody to come in and do the work necessary to get the property turned around and fixed up? Without a construction loan or a large amount of working capital cash going into a deal, the cash flow from properties usually cannot support large projects that are needed. Major things like a new roof, a new parking lot, new plumbing, new foundation. This is a situation that a lot of mom and pop owners find themselves in because they're living off of the cash flow and they don't have a large war chest for capital expenditures when major issues inevitably come up, especially on these older buildings. Bridge loans are a really necessary part of keeping the multifamily and commercial real estate space moving because they allow owners to be able to take over distressed properties. So to condemn all bridge loans as being irresponsible is irresponsible. And that brings us to a second layer of risk, the second mortgage, or the mezzanine debt. It's basically to borrow a second amount of cash against the property because the buyer can't afford such a large down payment, or if putting that much cash into a deal would lower the returns significantly, that investors wouldn't be interested in it. The more cash you put in, the lower the risk, but also the lower the returns. The more you can borrow, the higher the returns. And so balancing the risk and return ratio is the responsibility of every owner when they're putting a deal structure together, and every investor when they're looking at the returns versus how much risk they're going to take on to get those returns. Mezzanine debt is usually a higher interest rate, and it's also variable. So if an owner had two loans on their property, both of them were going up, you can see how this can turn into a mess really quickly. If a property cannot support good returns at lower loan to values in the 60 to 75% range, then it's too risky. And right now we're seeing exactly why, as a payment on a primary and a second loan are both going up. There's not enough income to then do the business plan, which is to fix the property up. And even worse than not being able to fix the interior of the apartments is not being able to keep the exterior of the building up. One of the biggest factors of rentability in multifamily is curb appeal. If a prospective tenant does not feel safe when they're coming into a community, or they're getting the sense that it's not well taken care of, it doesn't really matter how nice the inside of the apartment looks. People are not going to rent it. So as budgets get squeezed, maintenance goes down and vacancy goes up. This is added to the additional vacancy that the renovations are going to have in the first place. And third, this just creates a feedback loop, a cascade of failures. When things go wrong, it's usually not just one thing. It might be one small thing that leads to another small thing, and the next thing you know, you have a snowball running out of control down a hill of high expenses and low income, because the less people who move in, the less money there is to then keep up on the maintenance of the property. Well, what about buying a rate cap, you may ask? Most multifamily properties going in at the height of the market and getting loans at extremely low interest rates did buy a rate cap. They're extremely expensive, but worth it. But what we're going to be seeing over the next 1 to 2 years is those rate caps are going to start to expire, and they need to be repurchased. This can be hundreds of thousands of dollars, and if a property is already struggling, is not going to have enough money to be able to renew that rate cap. So one, we have a problem with rising interest rates that are going to affect both primary loans and secondary loans on mezzanine debt. We have the typical short terms that have always been an issue in commercial real estate that are really going to start affecting the refinance and the sale market coming up. And those rate caps are expiring, which then leaves less money available to keep the property up, and that drives up vacancy. Third, that creates a feedback loop where a property that's in trouble will continue to spiral by not being able to get enough residents in, because their payments keep going up and their income keeps going down. So when is it time to panic? Well, as we talked about at the beginning, panic is really never a good thing in any kind of investment. Some other reasons that you shouldn't panic, other than you just shouldn't be panicking, are because the news is making this out to be a bigger deal. A couple of the reasons is because some operators have had a lot of foreclosures because their style of buying properties really wasn't able to absorb the impact. So you have some companies with multiple properties foreclosing, and especially if they're large companies with large properties, this is going to skew the averages. A lot of dollars are being foreclosed on with a few larger companies. And sometimes it's just too late to save a deal that's going bad at this point. So what do we do with this information? Diversify. Don't get your investing advice off of the news, and being able to recognize opportunities when they're coming are how we're not only going to recover from some of the issues that we've been seeing in the commercial multifamily space lately, but also to be able to prosper. We're going to come out on the other side of it even stronger than we were when everything was going great. Just keep investing and keep investing smart. Build your net worth, build your passive income, and build the lifestyle of your dreams. It's going to be okay. We're going to be okay. You're going to be okay.